What you need to know before buying health insurance. There are 5 things to consider before making that decision. You want to choose a top-notch insurance company in your area. You also want to know the type and size of the network of the plan and know what the plan covers. You also need to know how the plan pays for your medical bills, and you also want to work with an insurance broker or agent that has your best interest in mind. The first thing you need to consider is the insurance company. The bigger insurance companies often have a bigger and wider network. Bigger insurance companies are more widely accepted by doctors and hospitals. The next thing you need to consider is the network. Now, what is a network? A network is a group of doctors, hospitals, and other healthcare providers that a plan has contracted with to provide medical care to the plan's members. Now, there are really 4 different types of networks that you're going to come across. The first is a HMO, which stands for Health Maintenance Organization. A HMO is a type of network where it's considered to be a closed network. What that means is you have to see the doctors and hospitals that are only inside the network. If you go outside the network, then the plan won't pay, and you'll have to pay everything out of your pocket. So HMO, normally the premiums are lower and the co-payments are lower, and also most of the times that the co-insurance might be lower. But it's one of the more restrictive networks. Now, the only time it will pay when you're outside the network is in case of emergency. Let's say you are traveling on vacation and you become ill, or you get into an accident and you go to the hospital, then the plan will pay. Okay, so it'll cover you for emergencies. The other thing with the HMO is that you have to select a primary care physician. This primary care physician is the one who pretty much controls your medical care. And if you need to see a specialist, let's say he discovers you have some heart conditions and he's not a cardiologist, then he'll refer you to a cardiologist within the network so you can start getting treatment by a cardiologist. Okay, the next type of network is a PPO, and this stands for Preferred Provider Organization. A PPO is a network which allows you to get service within the network and also outside of the network. But it's in your best interest to stay within the network. As with pretty much all networks, the providers have agreed to charge a discounted rate to the members, and then people who are not members will pay the regular rate. So you're always getting a discounted rate by being in the network. But with PPO, if you choose, you can go outside the network. Let's say you have this particular doctor that you've been seeing for a lot of years, and you want to continue seeing that doctor, and you don't mind paying a little bit of money out of your pocket to see that doctor. So then, yes, you can go see that doctor. When the PPO pays, it most likely will only pay maybe 50%, and often your deductible may be doubled by going outside the network. So it does pay, but again, it pays more if you stay within the network. Okay, the next one is a EPO, which stands for Exclusive Provider Organization. EPO is very similar to HMO in the sense that you have a primary care doctor, and the EPO is more of a smaller type network than the HMO. It's often more localized. It has less hospitals and less doctors involved. The one thing about the EPO though is unlike the HMO, which will pay you, which will pay if it's an emergency outside the network, the EPO may not pay. So you have to be careful about that. Okay. The next one is a POS, which stands for Point of Service. The POS is sort of like a hybrid between the PPO and the HMO. You still need to have a primary care physician. However, that primary care physician can give you a referral outside the network. For instance, let's say you contracted this disease and the only place you can get the treatment for it is Mayo Clinic. Your specialist can give you a referral to go to Mayo Clinic and the plan will pay. Okay. One other thing about PPOs and POS is sometimes they're a national network. There's some plans that have a national network where you can go to any participating provider anywhere in the country and it would be treated as an in-network visit. So that's a really cool feature. Like I said, there's certain plans that have that, and if that's what you really want, you can try to talk to your agent or broker to find one for you. And this comes in real handy, you know, like say you have a child who's attending college out of state, you know, so that plan would cover that child out of state. You know, whereas a lot of other plans either only cover them, you know, in the county that they live in, or with the HMO, it only covers within that network, which is often in a localized area. If you already have a primary care doctor or a specialist that you're currently seeing and you want to continue seeing that doctor, you need to check and see if your doctor is in the network. You also want to check to make sure the hospitals that you will use are also in the network, because you don't want to sign up for a plan and then find out later that your doctor or hospitals are not included in the network, or even worse, don't even accept that plan. It's also important to know what's covered in the plan. If you have any current medical conditions, you need to check and see if it's covered. Right now, with the Affordable Care Act plans, or you know, people call it Obamacare plans, one thing about it is that it waives pre-existing conditions. You know, so if you have those, you can get in the plan and you can get covered. Now, to get Obamacare plans, you know, you need to enroll in those plans during the open enrollment. Now, the open enrollment has already ended for 2015, and the next open enrollment is tentatively scheduled for November 1st and will run through January 31st. You know, and the only time you can get that plan is during open enrollment, or if you have what's called a qualifying life event, then you can get a special enrollment period where you can sign up. Now, qualifying life events are things like, you know, you get married or get divorced, you have a child, you move outside of your coverage area, you lost your insurance, you know, from your job or something like that. A qualifying event is what makes you eligible for a special enrollment period. Once open enrollment ends, the only plans that are available are the ones that are still subject to pre-existing condition. So if you have the heart condition, you know, let's say you had open heart surgery and a year ago and you're taking a lot of medications for it, those plans will not accept you. You'll get denied. And in the unlikely event that you are approved for one of those plans, then it will not cover anything related to the heart. You know, so that might defeat the purpose of you getting the insurance for the most part. Now, the other thing is, if you're contemplating any treatments or procedures like bariatric surgery or fertility treatments, again, you need to check and see and make sure if it's covered in the plan. There are some plans that will cover that, and many that don't. So if you if you think once you get insurance it's going to cover everything, it's not the case. You have to check and see what is covered and what is not covered. The next thing you need to consider is how the plan pays the bills. Now, with health insurance, it's, you know, they have cost sharing. What this means is that the insurance pays some of the cost and you pay some of the cost. Now, some of the components of cost sharing, first is the deductible. The deductible is the amount that you're responsible for before the insurance starts to pay. Okay, so it's almost similar to like on car insurance where you may have a $500 deductible, and if you have a little fender bender and it only costs like $200 to fix, then there's no sense submitting it to the insurance company because they're not going to pay because it's less than $500, and anything less than $500 is your responsibility. Same way with health insurance, except that deductibles are sometimes higher than the $500. So let's say a plan has a deductible of $2,000 and you have a bill of $50,000. That means the insurance won't start to pay anything that's less than $2,000. You know, so they'll only pay on the $48,000. Okay. The next component of cost sharing is a copay. What a copay is, it's a flat amount that you pay for a particular service, and it's not subject to the deductible. You don't have to worry about meeting a deductible for that. For instance, let's say the plan has a copay of $20 for doctor visits. What this means is that you can go see a doctor. You know, if the doctor normally charges $100 per visit, you're only going to pay $20 for that visit, and the insurance company pays the rest. This is very helpful if you know, you have, let's say you have diabetes, and the doctor says that he wants to see you every 3 months. You know, so it's good to have a copay where, you know, you'd be paying $80 for the year for doctor visits, as opposed to paying $400, you know, for doctor visits. So if you have a situation where you'll be, you know, using the plan on a regular basis, you know, if there's a copay, then that would make more sense. Okay. The next component of cost sharing is a co-insurance. Co-insurance, again, the insurance pays some and you pay some. So again, let's look at the same $50,000 bill. After the deductible, you know, then the insurance will start paying, and they'll pay a portion of it and you pay a portion of it. So it could be like a 90-10 plan. That's where the insurance would pay 90%, you pay 10%. It could be also an 80-20 plan, a 70-30 plan, or a 60-40 plan. You know, where the insurance is pretty much paying the major share and you pay a smaller amount. Now, you would pay this amount until you reach a certain point, which is called maximum out-of-pocket. Now, maximum out-of-pocket means that once your out-of-pocket cost reaches this level, then from that point on, the insurance company will start paying 100% of the bill. So again, let's use our $50,000 bill example. Let's say you have a plan and it's a $2,000 deductible and an 80-20 co-insurance with a maximum out-of-pocket of $5,000. Okay, the way it would work is you'd first be responsible for your $2,000 deductible. Okay, after that, then the insurance will start paying 80% and you'll pay 20% until your out-of-pocket cost reaches $5,000. Anything over $5,000, the insurance company will then pay 100%. Okay, so your maximum out-of-pocket cost is comprised of your deductible along with your 20% portion of the bill until it reaches $5,000, and then the insurance company pays all the rest. Okay, so that's how that works. So you want to work with your broker or agent to find a plan that meets your needs. You know, if you're looking for something where, you know, you're going to be visiting the doctor a lot, you want something that'll lower your out-of-pocket costs, and that's what a good broker or agent is supposed to do. You know, understand your needs and concerns and help you find a plan that that addresses that. Now let's talk about working with an agent or broker. Working with an agent and broker, you want one that is knowledgeable. he needs to understand health insurance. Preferably they've been doing it for a while, and especially understand the new health insurance law and know exactly how it impacts you. Okay, and they should also understand your needs, because basically that's what they're trying to solve. You tell them what you need and they find the solution. You want to have a broker who can provide a solution that addresses your needs, and you don't want a broker that's just looking for a sale, but one that's looking for a long-term client. That's very important, because most good brokers, they want to build a client base, and they want to service their customers because they'll keep coming back year after year. And also they rely on referrals, so they're going to take care of you because you are their bread and butter. And you also need to work with a broker agent who's available to you, one that's going to answer the phone, that's going to answer your emails, going to return your calls, because there's some who like to be a one and done. Once they sign you up, they're done with you till next year. But a good broker values you as a client and want to provide a service because that's what he's getting paid for. And again, you want to find someone that you feel very comfortable working with, and again knows that they have your best interest in mind. If you want to speak to a knowledgeable agent or broker who will help you find the best health plan that meets your needs and also fits in your budget, you can give us a call. Phone number is 312-857-4278. A master broker is a broker that values clients first. They want to provide a solution for the customer's needs, and they're very conscientious, and they're looking for a long-term relationship. Master brokers also have access to all the top-notch plans available in each state. So again, if you want to speak to a master broker like myself, who values a long-term relationship and will always have your best interest in mind, just give a call to 312-857-4278. Just do it right now while this is fresh in your mind. Why put it off till later? If you're watching this video, obviously you have some interest right now, and might as well get your questions answered, or just speak to a broker, and you can see where it leads from there. Okay, so once again, that phone number is 312-857-4278.